What we saw from Alphabet, Amazon, Apple, of course, does it change how you see mega cap tech and how you're balancing your portfolio? Marianne, if you don't mind, you.
Sure. Thank you. And thank you so much for having us. We've been in the camp that growth is in a bear market and growth being defined by the large tech companies. So we still believe these companies are in a bear market. We called it the COVID bubble with all the stimulus money that went into these names really, expanded their valuations. And they're just going through a period of valuation compression. These are great companies. We believe in the digital era and tech over the long term. But we think in the near term, this is not really where you want to be. But the Fed did pivot, and we're definitely seeing the risk on. So there are pockets of tech that we like, and we're focusing more on the semiconductors.
Yeah, that's very interesting. We're going to talk a little bit more about semiconductors and talk about Ford later on. Adam, I want to ask you the same question. Everybody says they're a long-term investor, but I'm sure some of your clients, when they see short-term losses, get concerned. So what's your perspective when it comes to tech and portfolio balancing?
Yeah, it's a similar story. That the problem is that we came off of a couple of years where tech really took off. Valuations got a little bit stretched, but everyone was in this kind of FOMO phase of investing where we were chasing returns. We didn't want to be out of names. And so a lot of investors chase names that really the story behind the stock was the driver, not the underlying fundamentals. So 2022 was a year of resetting valuations. And so what we're going to really look for in 2023 is a shift towards higher quality tech companies. So that's where we're focused. Are your names like Amazon, Alphabet, Apple. So it's really about those underlying fundamentals, the resetting of valuations. So we do like tech. We're just really selective in the names within tech.
Yeah, I think that's a very common story. A lot of people looking for profitable businesses and also free cash flow, whether it's tech or not. Less of an emphasis on growth. Also want to talk to you guys about central bank decisions. We saw the ECB's decision. That was pretty much what was expected. Also, our central bank's decision, pretty much what was expected with that 25-point basis hike. But the comments from Jerome Powell, were those surprising to you, Marianne, at all? And did he maybe lead us towards a possible pivot?
Yeah, well, we're saying the tone definitely sounded like a pivot, and using words like disinflation, inflation expectations anchored, really seemed to have more of a dovish tone, and definitely not what I was expecting, given how hawkish all the statements have been, going all the way back to Jackson Hole in August. And you definitely have seen, the market really now price in that we're not going to get to a terminal rate of 5%, and that the back half of the year, the market is expecting rate cuts. I'm more comfortable saying that this rally has some legs. I think we can rally into the summer. Now, we still have to deal with the debt ceiling. The markets have had a great move. They're overbought. We can get some consolidation. Right. But the internals, the technicals of the market are really telling us that this move is for real.
So, Adam, what do you think about what you heard from Jerome Powell? And then also, of course, we have the jobs report coming up today. And then next week we have CPI. And then on the 24th, we have PCE. How important are these different economic reports, starting with the jobs report today?
Yeah, so I would take the other side of that. So I think the Fed has shown over the last year that there's no intention of moving away from this tightening policy. And I think the market continues to try to front run the Fed in a way that they think that there's going to be a pivot. They think that there's going to be this pause. And I think that we need to stop trying to guess what the Fed's going to do and just really listen to what they've said. And so we think that the bond market has this right in the sense that interest rates are coming down because the Fed is going to continue to tighten. And even when they pause, you're still going to have quantitative easing, which is going to remove this liquidity that we've had in the market for the last, call it decade. So what we think is happening is that the interest rates out the curve, you're seeing the 10-year come from a 4.25 to below 3.5, is really driven by the fact that the economy is headed for a recession. What we think are the stocks and equities as a whole have gotten wrong here is that the equity markets are thinking that interest rates are coming down because the Fed's going to pivot. at best, the Fed's going to pause, but that's not necessarily going to change the dynamic. So what we think is that there's still some pain for equity markets here in the near term.